What is the rule of 72? Given a fixed annual interest rate, the rule of 72 is a quick way to estimate the number of years it will take for an investment to double in value. To use the rule, divide 72 by the annual interest rate, expressed as a decimal, to get the approximate number of years it will take for the investment to double. For example, if an investment earns a 6% annual interest rate, it'll be 72 divided by 6%, and it will take approximately 12 years for the investment to double in value. The rule of 72 is important because it provides a simple and easy-to-use method for quickly estimating the future value of an investment over time. It can help investors understand the power of compounding and the impact of different interest rates on their investments. The 72-hour rule can also be used as a rough guide to figure out how long it will take for an investment to reach a certain value or how long it'll take to reach financial goals like saving for retirement. Einstein thought that the rule of 72 was much more important than his theory of relativity. Luca Pacioli, known as the father of accounting, made the first mention of this rule. In his 1494 book Summary on Arithmetic, Geometry, Proportions, and Proportionality, he explains the importance of this rule. Being able to double your money in just a few short years is everybody's dream. How many times have you wished upon the stars that you would wake up tomorrow with 6 figures in your bank account? Well, we are here to tell you that it is possible. It is not a fantasy. And in today's video, we will be talking about the rule of 72. Stay tuned and get ready to learn. Step 1. The rule of 72. The rule of 72 is used to set financial goals, look at economic trends, plan for financial goals, evaluate investments, and deal with debt. The way it works is by determining how long it'll take for an investment to double while receiving a fixed interest rate. Here's how you can calculate it. Take 72 and divide it by the rate of return you hope to earn. For example, if you plan on earning an interest rate of 5%, divide 72 by 5, and that will give us 14.4 as our answer. The answer is the number of years it'll take to double your money. There are many advantages to this rule. It'll quickly determine whether we are keeping up with the latest trends. Along with that, it will ensure that you are on the right track with your financial decisions. It can also be used to calculate the inflation rate because it shows how many years it'll take for the value of the starting sum to fall by half rather than double. This rule also comes with disadvantages. For example, it can only be applied to assets that can calculate compound interest annually. This rule also has some accuracy problems, since it cannot calculate rates below 6% and 10% respectively. Nonetheless, do not let this drive a wedge between you and the rule of 72. Get a hold of a financial advisor who can thoroughly explain this rule in more depth and can guide you appropriately. Step 2. Compound interest. As stated before, the rule of 72 only works with compound interest. When we understand the rule of compound interest, we will have the secret recipe that will lead us to financial growth. Having discussed the rule itself, let's talk about compound interest. Compound interest is the interest that is added to a loan or deposit based on both the original principal and the interest that has been added over time. The interest is based on both the original principal and the interest that has been added up over time. This means that the interest compounds every time, resulting in a higher overall return. The rules of calculating compound interest generally include the following. First, the principal or initial amount of money is the starting point for calculating compound interest. Second, interest is typically compounded on a regular basis, such as annually or monthly. Third, the interest rate or the percentage of the principal that is charged as interest is used to calculate the amount of interest added to the principal. Fourth, The longer the investment or loan term, the more interest will accumulate and the larger the overall return or payment will be. Fifth, it is important to consider the compounding period. It means how often the interest is compounded when comparing investment or loan options, as it can have a significant impact on the overall return or payment. Sixth, some investment vehicles like saving accounts allow you to compound interest daily, which gives you more interest over time. Seventh, this is a compound interest formula, where A is the amount, P is the principal, R is the interest rate, N is the number of times the interest is compounded, and T is the number of years. Do you know what the fantastic thing is about compound interest? The longer your money is invested, the greater your earnings will be. In other words, the interest will be added to your initial investments, and the cycle will continue. Basically, invest your money in it and forget about it. Now, if you want to know how long it'll take to double your savings, you can use the rule of 72. Divide your interest rate. Let's say it's 6% by 72. This is how long it'll take you to double your money. So 72 divided by 6 is 12. When it comes to compound interest, look for one where the interest is high. The higher the interest rate, the quicker you will have your doubled amount. Step 3. Investments. An investment is when you use money or other resources to buy assets or make improvements with the hope of making money or making your money grow. Examples of investments include stocks, bonds, real estate, and businesses. The goal of investing is to grow and preserve wealth over time. There are many reasons why people invest, including: first, building wealth. Investing allows individuals to grow their money over time and potentially achieve financial independence and wealth. Second, saving for retirement. Investing is a key component of saving for retirement, as it allows individuals to earn higher returns than traditional savings accounts. Third, diversification. Investing in a variety of assets can help spread risk and protect against market volatility. Fourth, inflation protection. Investing can help protect against inflation by potentially earning returns that exceed the rate of inflation. Fifth, making money. Some investments like rental properties or stocks that pay dividends can give you a steady stream of money. Sixth, creating a legacy. Investing can also create a legacy for the future generations by providing them with wealth and assets. Seventh, philanthropy. Investing can also be used to achieve social or environmental impact through various investment strategies and vehicles, such as impact investments or sustainable investment. The rule of 72 can also be used in evaluating your investments. At some point in our lives, we all want to make an investment, and you can definitely use this rule to have a key insight on how long it'll take for your money to double. So long as the concept of compound interest exists, the rule of 72 will benefit you if you have ever considered investing. To better understand this rule, let's take a look at the following scenarios. Investment number 1. A savings deposit at a 1% annual rate of return. Investment number 2. Government bonds at 5% annual rate of return. Investment number 3. Mutual funds at 8% annual rate of return. Investment number 4. Stocks at 12% annual rate of return. Calculate everything using the rule of 72. We will see how long it takes for you to see the returns on these investments. Write your answer in the comment section and tell us what pattern you can see. If you are enjoying this video so far, do us a huge favor and give this video a like and subscribe. Step 4. Inflation rate. The inflation rate is the rate at which prices for goods and services as a whole are going up, which means that people have less money to buy things. It is usually measured as an annual percentage increase. The inflation rate is usually reported by a country's central bank or a government statistics agency, such as the Bureau of Labor Statistics in the United States. There are several reasons why the inflation rate can rise. First, demand pull inflation. When demand for goods and services exceeds the supply, prices will increase. This can happen when the economy is growing rapidly and consumer spending is high. Second, cost push inflation. When the cost of production increases, companies may pass those costs onto consumers in the form of higher prices. Examples of this include rising oil prices or an increase in the cost of wages. Third, built-in inflation. When companies and workers expect prices to rise, they may build that expectation into their prices and wages. This can create a self-fulfilling cycle of inflation. Fourth, monetary policy. Inflation can also be caused by expansionary policy, such as when a central bank lowers interest rates or increases the money supply. This can lead to an increase in borrowing and spending, pushing up prices. Fifth, international trade. If a country is importing goods from other countries that have a higher rate of inflation than their own, it could cause prices to rise. Sixth, government policies. Some government policies such as subsidies, tariffs, price controls, and taxes can contribute to inflation. It's worth noting that some of these reasons are considered normal and acceptable for inflation, while others are considered abnormal and in need of control. You may have heard on the news about the current inflation, but what does this mean actually? An inflation rate is the rate at which prices tend to increase over a certain period of time. Things like household goods and services are affected by it. It costs more to buy the same things as last year. The rule of 72 will help us determine how long it'll take to beat inflation. If the inflation rate averages 3% year after year, and we do the math, we realize that the price will double in the next 24 years. So it's gonna be like 72 divided by 3 is 24. However, if the inflation rate stays at the current 6.8%, in just a span of 10 years, the prices will astronomically double. By using this rule, you can financially plan ahead to stay ahead of the game and avoid getting beaten down by the inflation rate. Step 5. Savings. Savings are the portions of income that are not spent but are instead set aside for future use. The pros of saving include the ability to have funds available for emergencies or planned expenses, the ability to invest and potentially earn a return on those savings, and the ability to reach financial goals such as buying a home or saving for retirement. The cons of savings include the opportunity cost of not using the funds in the present and the potential for inflation to decrease the purchasing power of the saved funds over time. The rule of 72 has a lot of advantages when it comes to your savings. It enables you to project when those savings will end up doubling. What is the first thing you think about when it comes to your savings? Is it keeping your savings at home? This is too risky and easy to lose. Is it the stock market? Well, this has a higher chance of growing your money and a higher chance of losing it. Maybe it's opening a savings account at your local bank. If you are lucky here, you might earn 1% interest on your savings account. This is usually the lowest hanging fruit. Setting a goal to save is good, and setting a budget to save is a great idea as well. But you should also know how long it'll take for you to double your investment. Let's take a look at these examples using their rule. When 72 is divided by the rate of return, the investment will have doubled in value. For example, let's say you have $1,000 that you want to save in the bank. Let us also say that you will earn a percentage of interest every year. Divide that by 72. And that means if you put in $1,000 today, you are expected to have $2,000 in 72 years. We believe in 72 years you may not be in the position to appreciate the $1,000. There are many investment programs out there that can guarantee a minimum interest rate of at least 4 to 7% per year. You just have to do some research and sit down with a financial advisor, and they will show you much better routes to take. Let's use the previous example. You still have $1,000, but you can now put it in a savings program that has an interest rate of 5% per year. Instead of waiting 72 years, it will only take 15 years to double your investment with whatever amount you put in. 5% is just an example, and realistic rates can be higher. All in all, the rule of 72 is a mathematical shortcut that you can use to identify a number of things. This can include determining how long it'll take for your savings to grow, or how much money you will need to make to keep up with the inflation rates. Out of all the things we can use this rule on, one common thing we learn each time is to be patient. You don't have to wait around for too long if you start your journey to financial freedom today. We trust that you gained a lot of knowledge from this video. Comment below and let us know how you plan to apply this rule. Keep checking back for more. And don't forget to follow Legend Finance for more exclusive videos. Thank you for watching and have a wonderful day.